Welcome back, everyone, to another deep dive with us. Today, we're taking a close look at William Bernstein's If You Can, how millennials can get rich slowly.
A great choice. It's a compact but insightful guide filled with investment wisdom tailored for, well, as the title suggests, millennials.
Right off the bat, Bernstein lays out a pretty bold claim.
He states that there's an investment strategy so straightforward, even a 7-year-old could understand it, that can outperform 90% of financial
It's
professionals.
pretty bold, Graham.
He doesn't stop there, though. The real meat of the book is the 5 hurdles he identifies.
The obstacles that prevent people from achieving financial success, even if they know this simple strategy.
Exactly.
So let's dive right into those, shall we?
Let's do it.
The first hurdle Bernstein addresses is overspending.
Which, let's face it, is a challenge for everyone, not just millennials.
Especially in today's world, it feels like everything's pushing us to spend more.
Especially millennials who are dealing with things like student loan debt, and the constant pressure to keep up with everyone else.
Right, and Bernstein illustrates this point with a hypothetical scenario of someone earning $50,000 a year. To hit that 15% savings target, they need to be putting away $625 each month.
And that can easily disappear with all the little things we spend money on without thinking.
Exactly. That daily latte, those subscription services we forget about, they all add up.
One of the more interesting suggestions in the book to save money is to live with roommates for longer than you might normally consider.
It's definitely practical, maybe not always the most glamorous, but it could have a significant impact on your savings rate.
For sure. He then goes on to draw a parallel with The Millionaire Next Door, a book that found an inverse correlation between spending and building wealth.
Many people might think millionaires all live extravagant lifestyles, but The Millionaire Next Door actually shows that they're often incredibly frugal.
Prioritizing financial security over outward appearances.
It makes a lot of sense. It reminds me of the story Bernstein shares about his own father, a lawyer who lived modestly and saved diligently.
I love that anecdote. What was it his father said about their neighbors? Something like they owned a lot but didn't have a lot.
Yep, exactly. Meaning they were likely burdened with debt to maintain their lifestyle. It really makes you stop and think about your own spending.
It does. Are there areas where we could be trimming back to redirect those funds towards our long-term goals?
It's a great question for all of us. Let's face it, financial freedom rarely comes from keeping up with everyone else.
So true. Now, ready to tackle the next hurdle.
Absolutely. What's next on Bernstein's list?
Understanding the fundamentals of finance.
Which can feel daunting to many, but it's really crucial for making informed investment decisions.
It's like trying to bake a cake without knowing the difference between flour and sugar.
I like that analogy.
Mm.
So how does Bernstein break down these fundamentals?
He starts by using the simple analogy of a small business.
Okay, I'm listening.
He explains that stocks represent ownership in that business.
Okay, so you're a part owner.
Right. And bonds, on the other hand, represent loans to that business.
Uh-huh, so like a lender.
Exactly. And just as lenders get paid first if a business runs into trouble, bonds are generally considered less risky than stocks.
But they also usually have lower returns compared to stocks.
That's the trade-off.
So it sounds like understanding your risk tolerance is really important.
Absolutely. He introduces this concept of expected return.
Expected return.
He emphasizes it's an average over time, not a guaranteed outcome.
Oh, I see. So it's not a sure thing.
Right. He uses a coin toss analogy. You flip a coin, heads, you win $1, tails, you get nothing.
Simple, but I get it.
Your expected return is 50 cents, but there's a 50% chance you'll walk away with nothing.
That's a great way to illustrate the inherent risk in every investment.
And how important it is to be comfortable with that risk.
Some people are comfortable with more risk for the potential of higher returns, while others prefer a more conservative approach.
Precisely. Bernstein then dives into a really interesting point about how the interests of stock owners and bond owners can sometimes be at odds.
Interesting. How so?
Well, stock owners, they want the business to grow aggressively, and they're willing to take on more risk for higher profits.
Whereas bond owners are more concerned with stability and getting their initial investment back.
They're not as interested in taking big risks, and this leads Bernstein to favor government bonds over corporate bonds.
Interesting. Why is that?
Because government bonds, backed by the government's ability to collect taxes, are less likely to default than corporate bonds.
That makes sense.
Which brings us to another important aspect of investing, the stock market's volatility.
Ah, the ups and downs that can make even seasoned investors a little queasy.
Exactly. Bernstein reminds us that stocks can and do experience significant declines, referencing historical events like the Great Depression and the 2008 financial crisis.
Those were definitely tough times. It's easy to forget about those drops when the market is doing well.
He quotes a financial writer, Fred Schwed, who really captures the feeling of financial loss. He said, "There are certain things that cannot be adequately explained to a virgin, either by words or pictures, nor can any description I might offer here even approximate what it feels like to lose a real chunk of money that you used to own."
Wow, that's powerful.
It highlights the psychological impact of financial setbacks, which can often be more challenging than we anticipate.
Definitely. So how do we handle that volatility? A lot of people talk about trying to time the market.
Right, but Bernstein debunks that myth quite effectively. He says trying to predict market movements is like flipping a coin in a stadium full of people.
Okay, I'm picturing it.
Imagine 10,000 people flipping coins simultaneously. After several rounds, a handful might have correctly predicted every outcome.
Just by pure chance.
Exactly. The same principle applies to market timing. Those seemingly successful predictions are often just luck, not skill.
So we shouldn't be trying to outsmart the market.
He compares it to playing tennis against an opponent you can't see who's likely a professional.
Not a game I'd want to play. So if not market timing, what does he suggest?
Bernstein emphasizes the remarkable consistency of a simple approach.
I like the sound of simple.
He suggests a well-balanced portfolio, like a 3-3-3-3-3-3 split.
3-3-3-3-3-3. What's that?
U.S. stocks, international stocks, and U.S. bonds. It consistently delivers solid results without the stress and uncertainty of trying to time the market.
Sounds a lot less stressful. So it comes down to finding that balance between riskier assets like stocks.
And those considered relatively risk-free, like T-bills or money market funds.
Which brings us to the heart of investing, right? Finding that optimal balance between risk and return.
And sticking to that strategy over the long term. And for anyone who wants to dive deeper into these concepts, he highly recommends Jack Bogle's Common Sense on Mutual Funds.
Bogle was a legend in the investing world. Wasn't he the one who really championed the idea of low-cost index funds?
He was. He revolutionized the way people invest. His philosophy centers on simplicity, diversification, and minimizing fees.
Sounds like a winning combination.
His approach has truly empowered countless individuals to achieve their financial goals.
What was so special about the company he founded, Vanguard?
It's a mutual fund company that's owned by the investors in its funds.
Oh, that's really different. Most financial institutions prioritize their profits over their clients' returns.
Exactly. Bogle flipped that model on its head, ensuring that the investors' interests always came first. And you see that reflected in Vanguard's commitment to consistently low fees, which makes a huge difference in long-term returns.
So when it comes to investing, it really pays to seek out options that put your interests first.
Without a doubt. Ready to move on to hurdle number 3?
Bring it on. What's next on our journey through If You Can?
Let's delve into the fascinating world of financial history and debunk a common misconception along the way.
Okay, I'm intrigued. What misconception are we tackling?
The belief that a strong economy automatically translates to high stock returns.
Interesting. You'd think a booming economy would mean booming stock prices.
It seems intuitive, but history tells a different story.
So what does history actually reveal?
Bernstein points out that the best opportunities to buy stocks often arise during economic downturns.
Wait, so when things look bleak, that's actually the time to buy.
Counterintuitive, right? But those periods of fear and pessimism often push prices down, creating fantastic buying opportunities.
So it's about being contrarian, going against the crowd.
Precisely. He uses the example of investors who bought stocks during the Great Depression.
That must have taken some serious courage.
It did, but they reaped enormous rewards when the market eventually rebounded.
So their willingness to embrace risk when others were paralyzed by fear paid off big time.
Exactly. Bernstein contrasts this with the dot-com bubble of the late 1990s.
When everyone thought the internet would make them rich overnight.
It was a time of irrational exuberance. People were convinced that stock prices could only go up.
Which, of course, we know wasn't the case.
Bubbles burst. And Bernstein highlights this by sharing a fascinating story about Joseph Kennedy Sr.
John F. Kennedy's father. He was known for his astute market timing.
He was. He made the decision to sell all his stocks in 1928 when even shoeshine boys were giving him stock tips.
That's an interesting indicator.
He recognized that the market had become too frothy, detached from reality.
It's a great reminder to pay attention to market sentiment, the prevailing mood, and not blindly follow the herd.
Absolutely. Bernstein also brings in personal anecdotes from the dot-com era. He talks about seeing a TV ad featuring a day trader who had bought an island.
The ultimate symbol of success during that time.
Exactly. And he also mentions a relative who suddenly became obsessed with stock picking.
Classic signs of a bubble, unrealistic expectations, and excessive speculation.
It underscores the point that even intelligent people can get caught up in the hype, which is why having a clear investment strategy and sticking to it is so important.
So even though we should be aware of market sentiment,
It's not about trying to time the market perfectly.
because that's essentially impossible.
Right. Bernstein advocates for a consistent investment strategy, like the 3-3-3-3-3-3 portfolio we discussed earlier.
That approach naturally allows you to buy low and sell high without relying on precarious predictions.
Exactly. It removes the guesswork. And for those who want to delve deeper into market history and its lessons, he recommends Devil Take the Hindmost and The Great Depression, a diary.
Those sound like great resources for understanding the ebb and flow of the markets and how to effectively navigate those fluctuations.
So now, are you ready for hurdle number 4? This one delves into our most formidable adversary,
Oh, and who might that be?
ourselves.
Ourselves. You mean our own psychology.
Precisely. Bernstein argues that our own psychology can be the biggest obstacle to achieving financial success.
That's interesting. I'm curious to hear more.
He tells the story of a physician couple who panicked during the 2008 financial crisis.
Oh, no. What happened?
They sold all their stocks out of fear, only to buy them back later at record highs.
Talk about bad timing. That had to be painful.
It's a common scenario. Fear and FOMO, the fear of missing out, can lead investors to make impulsive decisions that sabotage their long-term goals.
It's like we're working against ourselves.
Exactly. Bernstein delves into the evolutionary roots of our behavior. Our brains are wired for immediate threats.
Our ancestors had to react quickly to survive.
Right. Those instincts don't always serve us well in the world of long-term investing.
Where patience and discipline are key.
He uses a humorous example to highlight another common bias, overconfidence. Did you know that 80% of people believe they are above average drivers?
Statistically, that's impossible. But I get it. We tend to overestimate our abilities.
And this overconfidence spills over into investing. It leads us to take on too much risk, chase after hot stocks, or believe we can outsmart the market.
We fall for the illusion of control.
Exactly. He also points out our tendency to extrapolate recent events into the future, assuming that current trends will continue indefinitely.
Like what goes up must keep going up.
Right. He gives examples of investors in the 1970s who were convinced that inflation would never end, and those today who believe it's a thing of the past.
Both views are probably wrong.
Exactly. Past performance doesn't guarantee future results, and markets often surprise us. He then dives into another interesting bias:
What's that?
our tendency to seek patterns, even in random events. It leads us to misinterpret noise as meaningful signals.
Can you give an example of that?
He describes a coin toss experiment where a professor asks students to document the results of 30 coin flips. One student fakes the flips, while the others genuinely toss coins.
Okay. And what happens?
The professor can easily identify the faker because their sequence rarely includes 4 or more consecutive heads or tails.
Interesting. Why is that?
Because we perceive these longer streaks as non-random, even though they're actually statistically common.
So we see patterns where none really exist.
And this spills over into investing. We see patterns in stock charts or economic data, misinterpreting random fluctuations as meaningful trends.
Yeah, it can lead to bad decisions.
Exactly. It's a reminder to approach investing with a data-driven mindset, not relying on our intuition or perceived patterns.
And for those who are fascinated by this interplay between psychology and finance, what does Bernstein recommend?
He highly recommends Jason Zweig's Your Money and Your Brain. It's a fantastic exploration of how emotions and biases influence our financial decisions.
It sounds like a must-read for anyone serious about improving their financial decision-making.
Absolutely. So, are you ready to face the final hurdle?
Bring it on. What's the last challenge Bernstein throws our way?
Navigating the complex and often treacherous landscape of the financial services industry.
Uh-oh. That sounds ominous.
Bernstein doesn't sugarcoat it. He advises us to exercise extreme caution when dealing with brokers, advisors, and most mutual fund companies.
Why such a strong warning?
Because he argues that many individuals in this industry are primarily motivated by their own financial gain, not necessarily the well-being of their clients.
That's a bit disheartening.
It's a stark contrast to professions like medicine or law, where practitioners are bound by a fiduciary duty to act in their client's best interests.
They have a legal and ethical obligation to put their clients first, but that's not always the case in the financial services industry.
Unfortunately not. And this lack of oversight makes investors, particularly those who are less financially savvy, vulnerable to exploitation.
So what's the best way to protect ourselves?
Bernstein goes as far as to compare the financial industry to an urban combat zone. He advises us to be constantly vigilant and skeptical.
Sounds like we need to be on our guard.
He specifically cautions against stockbrokers, newsletters, hedge funds, and most mutual fund companies.
A lot to be wary of.
He emphasizes that brokers don't have a fiduciary duty to put their clients' interests first. That can lead to biased advice and conflicts of interest.
It's a good reminder that not all financial professionals are created equal.
Exactly. Avoiding brokers completely can be tricky. They might be friends, family members.
It can get awkward. So how do we handle those situations?
Bernstein offers practical tips on how to politely decline financial pitches from people you know.
That's really helpful. It's important to protect your financial interests without damaging relationships. What about mutual fund companies?
He argues that, with the exception of Vanguard, most mutual fund companies are more focused on growing their assets under management.
Rather than maximizing their clients' return.
Exactly. Their incentives are not always aligned with their investors. He warns that high fees and hidden expenses can significantly erode investment returns over time.
Fees are often the silent killer of investment portfolios,
They might seem small, but they compound over time.
eating away at your returns.
Bernstein, again, sings the praises of Vanguard and their commitment to low-cost index funds.
So the key takeaway from this final hurdle is to be a discerning investor.
To do your research, ask questions, and be wary of anyone promising quick riches.
We need to take responsibility for safeguarding our financial well-being.
Absolutely.
So, to help make all of that a bit more manageable, should we try to condense those insights into some key takeaways for our listeners?
I think that would be really helpful, especially considering the wealth of information Bernstein covers.
Okay, so let's aim for like 10 actionable steps inspired by If You Can that our listeners can actually implement.
Love it. Let's empower them with concrete takeaways.
Perfect. So number 1, conquer those impulsive spending habits and embrace the power of saving.
Delaying gratification and prioritizing saving is truly foundational for building lasting wealth.
Number 2, master the fundamentals of finance.
Understanding the distinction between stocks and bonds, the relationship between risk and return, these are crucial concepts.
It's about empowering yourself with knowledge so you can make informed decisions and avoid those costly mistakes.
Absolutely. Number 3, learn from financial history.
It's about recognizing those recurring patterns and understanding the psychology behind market cycles.
History can be an incredible teacher.
Number 4, conquer your inner demons.
Meaning?
Become aware of your own behavioral biases, the ones that can sabotage your best-laid financial plans.
Oh, those. We all have them. Recognizing them is the first step.
Exactly. Then you can develop strategies to mitigate their impact. Number 5, proceed with caution in the financial services industry.
Remember, their interests aren't always aligned with yours.
Be skeptical, do your research, ask questions, and don't be afraid to walk away if something doesn't feel right. Number 6, prioritize paying down high-interest debt before investing.
Those interest payments can really eat into your potential returns.
It's like having a leak in your financial bucket. Better to patch it up before trying to fill it.
Exactly. Number 7, establish a solid emergency fund.
That financial cushion can protect you from unexpected events and prevent you from having to tap into your investments.
It provides peace of mind, knowing you're prepared for whatever life throws your way.
Number 8, embrace the power of low-cost index funds.
They offer a diversified, cost-effective way to participate in the long-term growth of the market.
Without the high fees and risks associated with actively managed funds. Number 9, consider a Roth IRA.
Especially if you're early in your career and expect to be in a higher tax bracket later on.
The tax-free growth potential can be really significant over time.
And finally, number 10, never stop learning.
The world of finance is constantly changing. Staying informed and adapting to those changes is key to long-term success.
Those are some great takeaways, a fantastic distillation of Bernstein's If You Can wisdom.
Now, for a final thought-provoking question, imagine you could travel back in time and whisper one piece of financial advice into your younger self's ear. What would you say based on what we've discussed today?
That is a really interesting question. It makes you really think about all the lessons you've learned along the way.
Maybe it would be the importance of starting to invest early, even if it's just a small amount.
Or perhaps the power of compounding, how those early investments can snowball over time.
It could be about embracing a more frugal lifestyle, breaking free from the need to keep up with everyone else.
Or maybe it's about surrounding yourself with the right financial professionals, finding people who genuinely have your best interests at heart.
It really makes you think, doesn't it? Like, what one piece of advice could have made the biggest difference in our own financial journeys?
It's a humbling exercise for sure.
Maybe it's realizing that time is our greatest ally when it comes to investing.
Starting early, even if you can only invest small amounts, can make a huge impact down the road.
Or maybe it's the understanding that true financial security isn't about having a fancy car or a big house.
It's about living below your means, prioritizing saving over spending.
And maybe it's also about the importance of finding those financial professionals who are genuinely looking out for your best interests.
It's worth taking the time to find someone you trust, someone who's more than just a salesperson.
Before we wrap up, let's do a quick review of those 10 actionable steps inspired by If You Can. Consider these your guideposts as you navigate the path toward financial well-being.
A roadmap to help you stay on track.
Exactly. So, number 1, conquer those impulsive spending urges and embrace the art of saving.
Saving is the cornerstone of building wealth.
Number 2, master the fundamentals of finance.
Understanding the basics of how markets work, what stocks and bonds are, and how risk and return are related, it's all essential.
Number 3, learn from financial history.
Recognize those recurring patterns and gain insights into the forces that drive market behavior.
Number 4, become aware of your behavioral biases, those little mental traps that can lead you to make irrational financial decisions.
We all have them, so understanding how they work can help us avoid making those costly mistakes.
Number 5, proceed with caution in the financial services industry.
Remember, not everyone has your best interests at heart. Be skeptical, do your research, and choose your financial advisors wisely.
Number 6, prioritize paying down that high-interest debt.
Get those financial burdens off your back so you can focus on building wealth.
Number 7, establish that solid emergency fund.
That financial safety net will give you peace of mind and protect you from unexpected events.
Number 8, embrace the simplicity and effectiveness of low-cost index funds.
They're a great way to participate in the market's growth without the high fees and risks of active management.
Number 9, think about opening a Roth IRA, especially if you're young and anticipate being in a higher tax bracket later on.
That tax-free growth potential can really add up over time.
And finally, number 10, never stop learning. The world of finance is always changing, so make it a habit to stay informed and adapt as needed.
Those are some great takeaways. I hope our listeners feel empowered to take control of their financial futures.
Me too. Bernstein's If You Can is a great resource for anyone who wants to start building wealth and achieving financial independence. And remember, it's a marathon, not a sprint.
Be patient, stay disciplined, and enjoy the journey.
Thanks for joining us today for another deep dive. We'll see you next time.